Welcome to the Techno Fundamental Report for May the 7th. Everything is about technology. You know, technology stocks have been a pretty good place to invest really since the 1980s. You know, when Microsoft came up with the operating system for personal computers, the technology industry has just done nothing but get bigger and bigger and bigger. So when you start evaluating this market, meaning the technology market, you need to look at some certain factors. Now, what I have here is a ratio where I'm comparing semiconductors to the equally weighted S&P 500 going back to 2016. So an extensive period of time. And as the line goes up, it's saying that the ratio of the semiconductor stocks is outperforming the average S&P 500 stock. And you can see it's just absolutely gotten parabolic here. So what is on everyone's mind, and I hear a lot of comments about, is we're worried about a bubble similar to the dot-com bust. So let's go look at that. If you look at the dot-com bust, now this is a graph showing, and I've got it as a monthly graph showing the S&P 500 compared to several moving averages. And you can see the rollover and the breakdown. It's pretty darn clear. Now this is the financial crisis. You can see the same basic pattern. So if we look at where we are today, and I'm just looking at the S&P 500, this doesn't look anything like what was going on in the dot-com bust. As you can see, it's definitely making new highs and definitely in an uptrend. So the trend is your friend. Now, if you go back and look at the dot-com bust, the main player in that universe was Amazon. It was a phenomenal situation. We started buying Amazon 6 months after it went public, which is in this area here. And then it just started to get into an uptrend. And then it was just an absolute parabolic up move, major correction in 99, but then back, forming a bubble here. So how can we look at this and determine, or at least have an educated guess as to what a bubble looks like? Well, I think sentiment is important. Now, the thing to realize about sentiment, now what we're measuring is fear and greed. So when everyone is, greedy, you're going to get very high readings for sentiment. Now, I've gone back to 1997 on this ratio, which is where we're taking the bullish recipients of the survey minus the bearish recipients of the survey. And so when you get up to readings of like 60, it's basically saying nobody is bearish and everybody is bullish, because at the zero line is the neutral line. But you can see here, going into the 2000 dot-com bust, there was very little pessimism. It was pretty optimistic and things really built. So the point I'm making here is that when using sentiment, it's somewhat of a long-term process, because it's a building. It builds and it builds and it builds, and then it finally just peaks out. So if we look at where we are today, you can see that we're nowhere up into the 60 area. We're not even above 25. So you've gotten a lot of pessimism in here due to tariff scares, inflation scares, war scares, private credit scares. Everybody's scared, and you're not getting that solid optimism. So what I'm just simply saying is that in a bubble type situation, I would bet on this indicator as being a pretty good way to get a handle on it. Another one is the CNN has a fear-greed index, and it does say we're in greed right now. Now, they have extreme ranges, just like I showed you here just a minute ago. But there's different ways to measure sentiment. Now, this book, 1929 by Andrew Sorkin, I took a section of the book that I thought was really interesting and appropriate to today. So in the chapter that is titled September 2nd, 1929, it discusses a gentleman by the name of Roger Babson. He's an economist, but he also, owns a college. He teaches at the college, and he's also an investment advisor. And he basically says more people are borrowing and speculating today. Now remember, this is September of 1929, and the crash came in October, late October. Most people are borrowing and speculating today more than ever in our history. Sooner or later, a crash is coming, and it may be terrific. Wise are those who now get out of debt and reap their sales. This does not mean selling all you have, but it does mean paying up your loans and avoiding margin speculation. Then if you read on in the book further, by the way, I recommend the book. It's very well written. But driving much stock buying was an explosion in broker loans, or margin, and they were paying 20%. You may want to pause your video player and read this text. But what was happening was, the servants who worked for the millionaires were borrowing money up to 90%. They could get 90% margin. And so when and the shoeshine boy, that was the old story about Joe Kennedy. But, when you start seeing that pattern of a long, extensive period of optimism, that's when you get nervous. So you can't listen to the news because that's just not going to help you. So let's take a look at the market right now. Fortunately, today on the NASDAQ, we got a follow-through day. Well, NASDAQ was up 2% today. Very nice uptrend. Looking pretty darn good. S&P 500, same thing. We were up 1.5% roughly. Follow-through day. So we're getting multiple follow-through days. This is very, very important. Now remember, a follow-through day is just simply saying, are the institutions coming in here and buying and then getting out? Or are they coming in and consistently buying and accumulating stocks, putting their cash in? So far, it looks like accumulation. Now, let's look at a couple of stocks that we can understand some patterns here. This is a company called DigitalOcean. They just announced earnings yesterday. You can see here it traded over 14 million shares. Normally trades about 4 to 5 million shares a day. So 14 million shares is, it's 3-4 times what it normally trades. 3 times. Very high volume. So you know that this is either Fidelity or Charles Schwab or Merrill Lynch or one of these big institutional houses that are buying this stock. I mean, it's not your Aunt Sue buying 100 shares. So being that the market is efficient, I believe the market is efficient. Not completely, but mainly. And so the market has all the information. So you can do all your homework that you want to do. But until these institutions who have done their homework, they come in and start buying this thing. So you can see yesterday it was about a 30 to a 40% move yesterday. So, and I must disclose these are stocks that I currently own for myself as well as my company. Here's Intel. Now this is an interesting situation. The government came in and bought 10% of the company, the U.S. government. And their products are starting to really catch hold for AI. And so they manufacture CPUs, which is, when you think about it, the way I understand it is the CPU is more for autonomous intelligence versus just long language models. So it's like, if you have an autonomous car, it's got to have CPUs in it. If you have a robot, you got to have CPUs in it. But anyway, it's just an interesting thing that's going on here. The addressable market is quite large. This is almost a $600 billion company, but they're doing quite well. Stock looks pretty darn good. Now, as far as buying it is somewhat extended here above this base. So what I would recommend is that you wait for some type of consolidation and then a new breakout before committing new capital. Here's Taiwan Semiconductor. Like we said at the very beginning, this market's being driven by technology, but hasn't it pretty much always been driven by technology? I mean, you go back and look at Walmart back in 1974. The reason Walmart was so successful was because Sam Walton adopted IBM computers, hooked to satellite dishes to control his inventory so he could have everyday low prices. That made Walmart. So it's technology. So here's Taiwan Semiconductor, the world's largest manufacturer of semiconductors. We're talking about a $2 trillion company. I do hear they're going to be opening facilities here in the United States. Now, we don't own Dell, but I'm taking another look at it. I did own it. I sold it because it kind of got sloppy on me in here, but it's coming right back. So Dell, you had a nice gap up here in volume, not above average, but that doesn't matter. It's the highest volume in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. Plus, you got a meaningful move in price. So take a look at Dell. But again, I would tell you a gap up is tricky, and you need to set your stop loss at the bottom of the gap up. So if you have any questions, please let me know. Thank you very much.